Hi, everyone. Thank you so much for joining for this panel. I'm very thrilled to say that joining me for this is Alexander Wynaendts, and we're here, of course, to discuss why Europe needs strong financial markets to transform our economy. Thank you, Minister, for that wonderful introduction. We're going to try to build on some of the things he said, but in order to talk about why we need strong financial institutions, we should probably start with where Europe is in terms of the economy, where we have ECB hiking to historic highs of interest rates. The data, economic data, has been bumping along the bottom, shall we say. What is the biggest risk for Europe right now?
Well, I think before we start to talk about big risk, I also would like to share that you made a point about data bumping at the bottom, is that if you look at 2024, I think there is reasons to be more positive. So since it's the last session, let's try to end on a high note. So why are there reasons to be more positive? First of all, we're seeing signs that inflation is abating. Now, is it going to come down further as it needs to, or is it going to be staying there, is probably the question. Interest rates will follow, and that means that the outlook for interest rates is rather more stable for a period of time and then declining. And that means that the consumer is much more confident and will be more confident. Inflation is one of the main items that consumer get worried about. And as you know, the economy is really very dependent on the consumer. That has been driving the economy. And if you then look at a number of other factors, what you also see is the energy price. A year ago, we were all very concerned about what would happen to the energy. Would we be able to go through the winter without having to pay outrageous price for gas? The reality today is that our reservoirs are completely full. We have more than enough for the winter. So this idea of high prices of energy that haunted us last year is not haunting us this year again.
And look, a lot of that market, the market right now does reflect that positivity. We've kind of gotten all hopped up on this idea of cuts. I think the bond market is on track for its best month since 2008. Are you confident that we are in that stable place with financial policy, with monetary policy rather, and cuts are the next thing to come?
So, yes, cuts are the next things to come. The question is, for how long will be stable? Is it going to be for a number of months? Is it going to be for a year, more than a year? I think that is the question that we are still waiting the answer for. But what I want to say on the general economy is, so if you believe so, and if you indeed recognize that consumers have a more positive outlook, we don't have to worry about energy prices, then the elements are more positive for 24 than they were in 23.
So what is that exactly? Is that no recession, soft landing? I mean, the landing words have lost all their meaning. Let's be clear. But what does that actually look like?
So what I would say is that if you look at the sentiment, and if we look at sentiment in the country that I represent, Deutsche Bank in Germany, then you would probably think that you're running into an economy that is at -3% to GDP. The reality and the numbers show something very different. We are around zero or slightly below zero. And technically, as you know, 2/4 of negative is a recession. But it's just around zero. So what we expect is to see an improvement next year, probably more accentuated in the second part than the first part of next year. We're not looking at a rebound, but we are looking at an economy probably at 0.5.
That doesn't sound like an economy that the ECB would be pressured to cut massively into.
And I think that's a very good question, because that's the fair point. How long will rates will stay longer? On the other side, I also want to remind you that we are coming from a situation that was not normal. Negative interest rates is not normal. That is something that has to adjust. We are in the phase of adjustments right now. And the interest rates at the level that we have are still relatively low compared to the long-term horizons. So in a sense, we're going back to a normal, and actually that is a positive thing to do. And if the central banks are able to get us back to normal without causing a big recession, I would say they would have done a tremendous job.
Well, part of the tightening in this market that the ECB has done, the reason it's perhaps more acute in Europe than it is in the US is because of this question of financial markets in this country, that you have less cross-border flows, you have less investments, you have corporations very dependent on banking for lending. If we are to enter a slight downturn, how at risk are we of things becoming undue in terms of tightening because of that setup?
So just for the context, in the US, banking represents 20% of financing of companies. 80% is in the market, capital markets. And our previous speaker spoke about that. In Europe, it's the other way around. the banks provide 80%, 70 to 80% of all financing, capital markets only 20%. And that means that the banks have a very big role in Europe. And you're right, if we see a decline in the environment, we'll see tightening of banking. Banks will be more careful to lend because they cannot lay the risk off, because they have to keep it on their books. So that is not going to be a positive. And what I want to say is that banks today are in a much better shape than they've been. If you look at the capital position of the banks, it's been much stronger than it was in the previous crisis. And that should be a positive. Non-performing loan levels are still at historic lows. We have not seen a pickup. That will come, and it's expected to come a bit later, but we haven't seen that yet.
Yeah, well, I do have to ask, because we did see very clear signs of hurt in the European banking system. I mean, it was in your first year of chairman at Deutsche Bank, and what a trial by fire it was to see one of Europe's biggest bank be absorbed by its crosstown Swiss rival between Credit Suisse and UBS. Is that going to be the only instance of fragility we'll see in the European banking system? Are we stronger now, or are there still things that concern you?
I think the European banking system, the banking system regulated by the ECB, is now in really in good shape. It's a strong position. We also have to make sure that we are not too strong, because if we are too strong and we put too much requirements on, then we risk also to be too tight in terms of lending. And we need to find that right balance. And I think that's a discussion that we also engage with regulators. How do we make sure we find the right balance between, on one side, being strong, on the other side, also playing our role? Banks want to play the role. We are part of the solution. I think this is very important to recognize. We're not only there when things go well, we need to be part of the solution also at times that things are more difficult.
What does that look like? Would that be part of a capital markets union, for example, part of that solution?
Well, that's part of the solution. As I said earlier, banks take up to 70-80% of financing. The remaining part is the capital markets. We need a European capital markets. The market is not deep enough. And why is this also important? And here also Pierre Moscovici alluded to it. If you look at the levels of indebtedness of governments, there is not much room anymore left, with a few exceptions of countries, large countries like Germany and Netherlands and some smaller countries. But by and large, the level of indebtedness of government is such that they cannot anymore increase that. And when we talk about energy transition, we talk about amounts that are 600 billion a year additional, or a trillion, depending on who the source is. These amounts are way too big for governments and banks to finance. The only solution is a deeper capital markets. And that is, in my view, to be part of the solution, to be able to finance the promises that we are making.
Yeah. Just on the point of fiscal, because if fundamentally the economy is okay, the consumer is okay, is the risk then a fiscal policy mistake? Too much deficit spending, issues with finances within countries?
Well, the debt level of countries in Europe is a cause of concern. There's no doubt about that. And the markets do play a role here. And we know when markets become uncomfortable about debt levels, which you see spreads going up, in other words, the cost for borrowing going up. And that also leads to situations where these countries cannot really refinance themselves. So that is a concern. And we have seen this in the past. We are not seeing it right now, but we have seen this happen, and we need to be aware of it.
Also, to go back to this idea of a level playing field within finance, within financial markets, within banking, what has it meant to have a new competitor that is such a behemoth, to have the combination of UBS and Credit Suisse in the European market?
In the European market, what we see is that we have a significant number of banks, probably too many banks, and everybody is expecting that the logic is towards bank consolidation. Having said that, the conditions for that need to be met. And also here, my predecessor alluded to it, there's a banking union. We need to recognize we have different rules. We have countries that want to keep their own banks. So even though it looks logic and makes sense to talk about consolidation, because size does matter in the banking world, on the other side, the conditions to allow cross-country mergers or acquisitions of banking, these conditions are not yet all met. There's a number of regulatory conditions. There's also political issues. There is nationalistic feelings about owning and having your own banks in your country. So there's a lot of reasons that are explaining why this is not happening. Ultimately, it will happen.
Because, I mean, it's been talked about for a while. Even Deutsche Bank itself, I mean, you look at the Loomis acquisition, for example, and you all have said for a long time when consolidation happens, you will be the buyer, not the target. Have you been held back because of those regulations? Have you been looking at things and being, we wish we could, but we can't?
Look, we as a bank are firstly looking at making sure that we have a strong bank, strong capital position, a strong organization, we make the necessary investments. That's our first priority. The second priority is to look at alternatives. We need to have a strategy that is not dependent on M&A. That is the core of how we look at this at the sector. Now, if situations arise, we also need to be ready. So we as an institution want and will be ready for these situations if and when they arise.
So ready, but it's not the focus. Is that fair?
That's the way of putting it, yeah.
Okay. And, you know, you are no stranger to times of transformation. It was a trial by fire for your start at Deutsche Bank, but it was also a trial by fire at your start at Aegon. I mean, you had that little thing called the financial crisis to deal with.
And you're forgetting that I left at the COVID crisis. I started and ended at a crisis.
I wonder what you'll do in the next crisis. I'm going to see you CEO of Coca-Cola or something like that. But you did oversee this huge restructuring at Aegon, and it feels like we're getting hints of that in the banking sector. I mentioned UBS Credit Suisse. Every day there's a new headline of Barclays cutting jobs, cutting clients. There's a headline today about Nomura trying to cut costs. Deutsche Bank has been undergoing a transformation. Is this a transformative period for banking right now?
Well, the reality is banks have to adjust. The way customers interact with banks is also very different. Think about the number of branches all the banks have. Customers are not going to branches anymore. In some countries, they do a bit more than others, but by and large, there is a significant restructuring taking place. We need to make sure that banks are able to communicate with our customers in the way our customers decide. If they want online, we need to be there. If they want to do it by telephone, we need to be there. And if they want to go and see a branch and be face-to-face, we also need to be able to provide so. So for us, it's really important that we adjust ourselves to this new reality of interacting with our customers in a way they choose, not the way we choose. That's new for us.
Would you say it's a more difficult environment, given that?
It's certainly a more difficult environment. We are operating in a very competitive environment. We have a lot of new banks emerging. We also have non-banks. That, as you know, is an important sector. So you see a lot of changes. But I think at the core, the role that banks play for society, for our economies, is absolutely critical. And I therefore also believe that a strong banking sector is absolutely needed if we want to speak about a strong economy in Europe. And a strong banking means having a number of strong global banks. And because of the nature of the regulation in Europe, effectively it means that you will only see very large banks in large home markets. That's where things are developing. And as such, Germany being the largest home market in Europe is very well positioned to be also the home market for the largest European bank and a global bank.
Part of the way I think about this, though, and I kind of alluded to this, is there's just cost cuts going on at essentially every bank. Does that for you paint a picture of a very specific kind of 2024, a specific type of challenge for the year?
You know, the cost levels is a challenge, is an ongoing challenge. I think what is more important for most of the banks, we need now to make sure that we digitize all our operations, our back office, front to back, entirely digitized. We need to make sure that there's no more errors. We need to make sure that we create operational leverage. In other words, a fixed cost base that we can leverage and create more revenues on. You mentioned our acquisition of Loomis is a very good example where we effectively acquire an outfit that is going to bring us revenues on a stable base of expenses. And that's what you will probably see going forward. So it's not so much that 24 will be a year of cost cuts. No, it is about being much more efficient and also doing the things in the right way.
In terms of other risks in the financial system, you also, I think, maybe alluded to this. We had the UBS chair yesterday, Colin Kelleher, saying that one of the big risks is a non-banking financial institution, the debt buildup there, specifically private credit. He said that there's an asset bubble in private credit. Would you agree with that?
I do see that there are areas where the risks are probably taken in a different way. To talk about a general asset bubble would be too much. I think that you see clearly large institutions that are very qualified, so we should not generalize. But you don't need much of something going wrong for the confidence to go, and it's all about confidence. Just look back at the US. We had a small regional bank. Now, it was one that was well known because it had the name Silicon Valley.
Yes.
But
loved it too.
It was a small institution, and that institution effectively triggered, as you know, significant amount of other negative factors and confidence of customers. Because the moment our customers lose their confidence, there's not much you can do. And we've seen this exactly in Switzerland. Yep. It was a loss of confidence. Customers taking their money out. There's no way you can stop that. Just like catching a falling knife.
How does that risk, though, play out with private credit, for example, where they don't have, the same issue with deposits coming out and that sort of thing?
It's a good question. It's very difficult to give you a clear answer because we just don't know how big these amounts are, how they were underwritten, how much was placed into the market. We suspect pieces have been placed back into the market, but to what percentages? And also, we will always get surprises by buyers of the private credit. They will emerge out of places that we were not expecting. And that's a non-expected element that creates the crisis of confidence. And that's one thing really to watch.
Is there anywhere else that you're fearful of? If that's on an asset bubble, let's say, is there anywhere else that you say, okay, that's looking too frothy? At some point, that's got to be punctured if we are heading into a downturn next year. I
think this is the most common area, but it's quite a wide area. We have been speaking, of course, of real estate, commercial real estate, in particular in the US. This is not a new theme. Different ways of working, which means less offices. So there's a lot of changes taking place. And I think what we will see is inevitable that we will have some accidents along the road somewhere. Where they will take place, I don't know. But what I do know is that when they will take place, and when they do take place, they will spook. They will spook the market. We need to be prepared for that.
How would you prepare for that at Deutsche Bank, for example? Because it could come from anywhere. Kind of what you're describing. It's a lot of different threats out there.
And could come from anywhere. So what's important for us is that we have maintained very strong discipline in risk management, and we maintain a high level of capitalization. Because when you have a high level of capitalization, you can absorb shocks. In a sense, it is relatively simple. So that's what is really important, is capital levels, because that's what allows you to absorb the shocks that will inevitably come in one way or another.
Yeah. Are risk controls sufficient at this time, too?
It's all part of a bigger thing. It's levels of capital, it's risk controls, it's maintaining discipline, really maintaining discipline. And so often you see when things go wrong, you see that actually action was taken outside of the normal rules of engagement in an institution. And that's where the action comes. So for us, it's important to stay disciplined and maintain the level of capital.
Are you worried some of your peers might not be doing that?
I don't know. I just hope not. Because in our sector, just one accident leads to a crisis of confidence. And we have seen it very clearly in the US.
I guess, not to kind of go in a circle here, but the crisis of confidence, just to be clear, could it happen to European banks or no, because they're in a stronger position now?
What we see here in Europe is a couple of things. First of all, we have banks that are in a much stronger capital position. We have also the deposit insurance scheme. So most of our customers stay below the 100,000. They are effectively covered by their respective governments. And that creates more confidence. So
it's perhaps in private capital that there could be that crisis of confidence.
That's where you could see a crisis of confidence. On the other side, these credits are being committed for a long period of time, and they're not liquid.
Yeah.
That's the whole issue. So there's not so much to do there than to wait it out and to sit it out. And that's, I think, a bit our worry is where will it pop up? It will pop up somewhere, but where?
Can you prevent that? Regulation? How do you get in front of that?
Well, we believe that it would be good that we see a market that is regulated on a level playing field, that we have everybody on the same regulation. That's not the case. And I just hope that we do not need to see a crisis before regulation to step really in. Hopefully regulation will be able to step in before we have the crisis. Now, history will show that that's always a bit of a challenge.
I don't know why this reminds me of Jamie Dimon saying that private capital is dancing in the streets because of bank regulation. Has it almost gone inversely that post-SVB, post-Credit Suisse, they've gone after the banks, and then it's made private capital grow even bigger because of that type of regulation?
No, I don't think so. I just think that now it's becoming a theme. You probably will have seen also in Asia and China, one of the biggest non-bank financial institutions is being in trouble. So it will emerge in different places. Now, just hope that it can be contained. That is really what is my hope going forward. And the regulators here have done all they could to ensure that the banking system in Europe is strong and that the banking system therefore can be part of the solution of helping us grow the economy.
Right. You know, one of the other problems that European banks have, it's not quite fundamental, but it's just very depressed valuations in public markets. Profitability has been high rates have been kind to European banks. What do you think markets are getting wrong?
Predicting share prices is always something that you should never do for your own company. You can do for anybody else, but not your own company.
Well, we take it to the sector then.
I do think that the point, and I'm glad you bring this up, we also need to make sure that our sector is investable. So it's a very good thing to have very high capital buffers, but it does come at a cost, and it comes at a heavy cost. And for investors, therefore, if they have the opportunity to invest in other institutions in other parts of the world, in the US, for example, where the cost of doing business is less than in Europe, it's not surprising that capital goes there. This is an area that we bring to the attention to regulators and politicians, that it's great to have high buffers, but we need to make sure we have the right balance. We have the right balance and we create a level playing field with other institutions. Now, Basel III and its implementation will probably lead to a better level playing field, but before that, it's clear that European banking institutions, they are have higher requirements than others, and as such, you see lower valuations. That's not helpful because lower valuations mean that it's harder to attract capital.
Right.
And if we want to play our role, and we need to play our role in the economy, we also need to attract capital. And that's where the balance needs to be found.
Bloomberg had a story today, to plug my colleagues, because I have to do that, that at the supervisory board at the ECB, they're looking at when the current lead goes, perhaps relaxing some of the barriers for payouts and making it easier for European banks to give out dividends. How far would that go to help fix some of these issues?
That's part of it. It's true that payout levels depend on capital levels. So if you have much stricter ways of calculating your capital levels, there is less room for payout. So it's all interlinked. What's important to me is that investors understand and accept and believe that we all here in Europe are prepared to have a level playing field, and therefore we don't have a sector that's burdened more than the same sector in other parts of the world, because the capital is just going to flow there.
In the meantime, until we get there, I mean, as a chairman, you're almost, sort of like the statesman of Deutsche Bank, of going out to the people and talking to them. Do you see more interest from long-term investors in European banking at all?
So you're absolutely right. We engage with local investors. I do think there's now an interest in exploring it. It is clearly an interest because of the level of valuations. Let's be fair. It's low levels of valuations usually attract interest. I also think that investors are now seeing that with the implementation also of the same rules, Basel rules, in both Europe and the US, the level playing field will effectively be a positive for European banking sector. I also believe that investors were expecting, after the aggression of Russia and Ukraine and the increase of energy prices, a significant negative impact on the economy, which has not yet taken place, and therefore pull out of European banking, the European banking sector, and I understand why, that they're now seeing that is not really happening. So there's a lot of factors that actually tend to a renewed interest, and we do see that.
So another, I suppose you could call it, structural issue with European finance is one of diversity. And I know you've been very vocal about the need for it. The ECB had a report, and it said in it very bluntly, banking is still a man's world, basically criticizing the industry, saying you haven't gone far enough. Do you think the banking industry has fully grasped the problem at hand when it comes to diversity?
So let me talk about Deutsche Bank. Probably is a good proxy for the whole sector. What you see is very clear. At the top, the number of women is just very low. Now, the good news is there clearly is a pyramid. And what you see is the next level, we already at around 35%, which is better, not good enough. And when you go to the level below that, and the intake level, we now are at around 50-50. Which is very positive, because at least that the funnel is there, and that should lead to an improvement over some time. It will take some time. Now, it's clear that if you have 50% intake, you don't have 50% output.
Yeah.
And that's a reality. So we do really make a lot of focus, because we believe not only in diversity in terms of male-female, but we also believe in a much broader diversity, bringing people from different backgrounds, different cultures, different perspectives will all add to diversity. And I think that the concept of male-female diversity is actually already a bit old-fashioned.
Well, I mean, not to harp on the old-fashioned, but I know you were looking for a woman to replace Christiane O'Reilly after she left the management board. How's that search going?
Ongoing.
Okay.
Would you apply?
I don't know. Does 5 years of an anchor at Bloomberg make me qualified? I'd be worried if it did, I think, Alex. Look, we have to wrap things up, but I just want to leave on one question, a little bit separate from the subject of this panel. But when you first came to Deutsche Bank, we talked about this, there were some stories written. He's not German. He's an outsider. Yes, you have a banking background, but you had come from a non-banking financial institution. He's going to have to prove something. I mean, the first year and a half, a lot has happened. What sort of have you learned from that? Is sort of this outsider persona coming in to Deutsche Bank as chairman?
I think it's a fair question. It's obvious for an institution like Deutsche Bank, the expectation would be to have somebody who comes from Germany Inc., speaks fluently German, preferably a banker. The reality was different. And I think the reality was different because the board at that point of time thought it would make a lot of good for the bank to also have a different perspective. We have a very strong management board, excellent CEO who is very well versed in Germany, knows Germany very well. So the idea was for me to bring what he doesn't bring, which is outside of Germany, my international perspective, my experience in the US and Asia. And it's been very complimentary, and I think it's been very much recognized also in Germany that makes a lot of sense. And it takes a bit of time sometimes to get used to different things, but once you get used, things are really been very positive.
Yeah, I hear your German is improving quite a bit, so.
Well, from a low level, always say that, yeah.
That's what I say about my German. My 5 words I'm going to add on. Alex, thank you so much. Everyone, please join me in thanking Alexander Wynaendts.
Thank you.